Welcome to this explainer. Okay, let's put ourselves right on a trading desk for a second. Imagine you're looking at a position you've carefully, meticulously managed over a long period of time. You've done the research, you've timed your entry perfectly, and you feel really confident. And then, suddenly, the rules of the game change. And the kicker? It happens entirely without your input. So, that immediately begs a rather uncomfortable question, doesn't it? Who really controls your portfolio? You might logically think that, as the position holder, you're the one in total, absolute control of your investment strategy. You're the one pushing the buttons, right? But the reality of the financial markets is actually quite different, and it's something every single serious investor absolutely needs to understand. Here's the deal. The issuer, the actual company whose stock or bonds you're holding, they hold the legal right to just change the board itself. It's what we call the invisible hand of the market. At literally any moment, this unseen force can completely reshape your wealth. And we're not talking about a market crash driven by panic here. This is a highly calculated, entirely legal move by the issuer simply exercising their rights. Okay, let's dive into this. Here is our roadmap for breaking down this complex financial architecture. We're going to start with the illusion of control, then look at the issuer's toolkit, examine their underlying motives, and finally, we'll uncover the back-end chaos this all causes. All right, Section 1, the illusion of control, shattering the myth. So this control is primarily exercised through the mandatory lifecycle. Notice the stark contrast here on the screen. With voluntary corporate events, you get a vote, you actually have a say. But with mandatory events, you have absolutely no choice. It universally impacts everyone, and I mean everyone, from the everyday retail investor all the way up to multi-billion-dollar funds. The industry essentially views you merely as a passive recipient of the issuer's decisions. Your consent, it's simply not part of the equation. Moving right along to Section 2, the issuer's toolkit, the nitty-gritty mechanics. Now, what's really interesting about this is how they actually pull it off. This is their aggressive arsenal. They have a whole variety of levers they can pull: consolidation, mandatory redemption, lottery systems, convertibles, and the compulsory acquisition or squeeze out. These are highly effective, very powerful mechanisms designed to shrink shares, force early repayment, or even forcibly flip your debt into equity. Let's break down one of the most common moves, consolidation. You might actually know this better as a reverse split. This is where the issuer just shrinks the number of shares you hold while simultaneously bumping up their par value. Essentially, they are restructuring the very DNA of your holding. A company can, seemingly out of nowhere, just decide that your 1,000 shares are now only 500. Then we have mandatory redemption. This is where a company forces the early repayment of debt, effectively terminating your investment way before you are ever ready to exit. And sometimes it gets wild. They actually do this through a drawing or a lottery. The issuer literally picks specific bond numbers completely out of a hat to be repaid early, leaving all the other bondholders totally untouched. It's kind of like a game of chance you didn't even know you were playing. But honestly, perhaps the most aggressive move in the entire toolkit is compulsory acquisition, known pretty widely in the industry as the squeeze-out. This happens right at the final stage of a corporate takeover. Once an offeror hits a very specific ownership threshold, they can unleash this legal force to make any remaining dissenting shareholders just surrender their shares. You don't want to sell? Too bad. The law says you absolutely have to. Which brings us to Section 3, the underlying motive, the big picture. So the crucial point here is the why. If we pivot away from the individual investor's plight and look at it from the corporate perspective, we see why issuers pull these strings. These actions, they are almost never about you. They are strictly about strategic capital management and managing the issuer's balance sheet. A board of directors is going to manipulate that capital structure to achieve their long-term goals. And this brilliantly illustrates exactly what I mean. Look at the shift here on the timeline, from high debt to low debt. By forcing these mandatory actions, a company can rapidly reduce their debt liabilities, pave a clear way to liquidate, or simply artificially engineer their capital so their stock price suddenly looks significantly more attractive to the broader market. It's financial engineering at its absolute core. All right, let's look at Section 4, the back-end chaos, lightning speed operations. Behind the scenes, this creates an incredibly frantic, fast-paced reality for clearinghouses and agents. Remember, we operate in a highly complex T+2 or T+3 settlement environment. Take a look at this timeline. Day 1, you execute a trade. Day 2, while your trade is literally still in flight, the invisible hand strikes. By day 3, the system is attempting settlement. The issuer is effectively moving the goalposts while the ball is already in the air. So, when an issuer restructures like this, an unsettled trade that you executed days ago has to undergo a critical, super complex process called transformation. The backend systems literally have to step in and fundamentally reshape that outstanding trade into a completely different security or a different quantity before it even has the chance to settle in your account. To ensure the wheels don't completely fall off the financial system, this vital information has to travel at absolute lightning speed. It moves from the issuer's agent, propagating outward through central securities depositories, or CSDs, and onto custodians just to keep the global market perfectly synchronized. It is a monumental feat of daily operational plumbing. And the stakes couldn't possibly be higher. Failure to accurately track these rapid moves leads directly to replacement risk. This is the incredibly high financial cost and, frankly, the severe professional embarrassment of an institution trying to deliver shares that literally no longer exist in that form. Mastering these mandatory mechanics isn't just about keeping good records. It is the fundamental, non-negotiable defensive line of professional securities operations. Which brings us to the final, lingering question I want to leave you with. Is your portfolio truly safe from the invisible hand? The next time you look at your carefully managed holdings, just remember those hidden mandatory mechanics operating right beneath the surface. These are forces that hold the legal right to reshape your investments in the blink of an eye, entirely without your input. Thank you so much for joining me for this explainer, and keep learning.